So what are some of the common misconceptions about Social Security and marriage? Oftentimes you hear folks saying, well, because we're married, we'll get a better Social Security deal. And that's true, but there's definitely some limitations and some things that you need to be aware of. So we'll talk about that on the program today. Plus, talk about the distinction between financial planning, retirement planning, investment planning, income planning. You hear all of those different expressions sort of tossed around, and I think a lot of people think, well, don't they all mean the same thing? The reality is that each one of those is sort of a little different, and each one of them can be very important at different stages of life. And we'll also tell you which one's the most important when you enter into retirement. Plus, we'll be talking about some opportunities in the international markets. There's been a long period of time where the U.S. markets have outperformed the international markets. So many investors, if they haven't been rebalancing, may find that their exposure to companies located outside the U.S. is in fact much more limited than what it might otherwise be. So we'll talk about all of that on the program. Welcome, good Sunday morning to you, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So before we get to all of those topics, we thought it would be good to sort of do a little recap of a couple of different headlines that popped up this past week. First of all, Gamestop. Well, I guess that's not popping up as much as it did a few weeks back when it was all the rage and everybody was chasing it and the value of the stock was going up to like $400 a share. The headlines this past week were a little bit different, primarily because GameStop has in fact declined down to like $40 a share. So that's a pretty tough slide within a short period of time. And one of the things that we said 3 weeks ago or 2 weeks ago, it's been this incredibly fast period of time where GameStop made headlines and now it's sort of evaporating into the background. And at the time we said, look, when these things happen, and you can trace bubbles back to the 1500s and when it was tulip bulbs in the Netherlands, when these things happen, be careful because you're trying to time something that it's going to be very difficult to time. GameStop, just one of the latest on the list, right? If you got in at the right time, you had to sell at the right time, because if you waited a few days, the stock promptly declined from $400 a share down to $40 a share. The big headlines this week were really more about the story of the aftermath. And when we talked about GameStop a couple of weeks on the program ago, we talked about it being sort of this David and Goliath story, and that was certainly what the media was spinning it to, because you've got these hedge funds that really lost a lot of money trying to short the stock, and then this army of individual investors came in and ultimately was able to push the stock price up, which caused those folks that were shorting the stock, meaning that they were betting effectively that the price was going to go down, caused those people to get squeezed, literally, because then they had to keep buying the shares at much higher prices, which then further accelerated the movement of the GameStop stock. Well, here's the reality, is that legion of sort of common Joes and amateur investors may have in fact had a couple of bazookas behind them. The first one is that it seems like there was also a number of hedge funds playing the other side of GameStop, particularly when there started to be this big movement in the price. So there were definitely hedge funds on the other side. It's funny, I think oftentimes we forget that every trade in the market involves two people, right? Because if I'm going to buy something, then that has to mean that somebody is selling something, right? So you've got two completely polar opposite parties that believe the opposite. And so we see where the army of amateurs that were in the middle of talking about all of the movement involving GameStop on the various social media networks were ultimately also had some hedge funds riding that wave on the other side as well. So maybe not quite as much of a David versus Goliath story. And then the other part of it was the conversation that was happening in Washington where they called a bunch of people in to testify before Congress. One of the twists on it is that the most vocal of those sort of amateur voices, an individual goes by the moniker of Roaring Kitty, okay, on the Wall Street Bets forum on the Reddit social media site, and his real name is a guy by the name of Keith Gill. And Keith did not have a particularly good week this past week, despite him still roaring as a kitty. The reality is that he wound up facing a federal lawsuit alleging misrepresentation and fraud as an amateur investor, and that the reality is he's actually a seasoned professional. And it alleges sort of the classic sort of pump and dump scheme, right? Where you pump up the price of a stock, get everybody else to buy it, move the price up, and then ultimately you sell it when it is high and leave others sort of holding the bag. It turns out that Roaring Kitty, aka or Keith Gill, aka Roaring Kitty, is in fact a licensed securities professional. He is a chartered financial analyst, CFA. He holds multiple brokerage licenses and was at the time, and this is where the story gets a little foggy, at the time he was, when he first started all of this conversation on social media, he was in fact an employee of a large insurance company. So we'll continue to hear more of that story, but it's starting to sound like a lot of that some familiar refrain that we see anytime you see something running up very quickly and then the reality hits and then you see it running right back down. I wonder if there's anything else out there that may be making headlines this week or this past week that might very well come into that same category. Let me just think about that for a minute. Let's see. Oh, Bitcoin. Oh, yeah. Forgot about that headline, right? Bitcoin 50,000. I'm out last night having a couple of beers with some friends, and there we go. It's the conversation turns to Bitcoin. Anytime, here's the general rule of thumb. I think it's pretty accurate. Anytime that you are out having beers with friends and the conversation turns to a particular stock or a particular financial instrument or a particular investment, stay away from it. Because if it's getting to the point where it's part of your beer banter on a Saturday night, the movement and price appreciation has already happened. It's already happened. If you're talking about over a bunch of beers on a Saturday night, been there, it's already happened. So be careful with that. Bitcoin, definitely in that same category. The reality is, here's the reality of it. And we've already started running into it with some tax returns that we've been preparing at the office. The more Bitcoin and cryptocurrency in general starts to get regulated, the more it's going to start to behave a little bit more rationally, because the more regulation that gets into it, the more things like it has to be backed by stuff. There has to be reporting. There has to be tax reporting. And here's the thing that has happened. If you haven't done your 2020 tax return yet, you will get asked a very brand new, first year ever, interesting question courtesy of the IRS. And the question is incredibly broad and intentionally so. Here's the question. Have you, and I'm going to try to remember it off the top of my head. I may miss a couple of words, but here it is. Have you bought, sold, received, exchanged, or otherwise engaged in any activity or financial transaction involving any cryptocurrency or similar currency? That's pretty broad. And that's intentionally so. Why? Because the IRS wants to tax it. That's the regulation that's coming. And once people start to see that question and say, wait a minute, I got to answer that question, they may wind up saying, maybe we need to take a little bit more closer look at what's happening. It's there on the return. Oh, by the way, it's not just a, question that they just kind of stuck in there. It's right below where your Social Security number goes. So you ain't going to miss it. You ain't going to be able to file your return without answering that question. So it's interesting how those two sort of all tie together. We're going to take a break. When we come back from the break, we're going to talk about the difference between financial, retirement, investment, and income planning. 4 different concepts that are important at different points in time in your life. All that and more on Dollars and Cents with Joel Garrett. So what's the difference between financial planning, retirement planning, investment planning, income planning? There are all of these different terms tossed around by people in the financial industry, and I think a lot of people think that those terms are interchangeable, if you will. But the reality is that they are kind of a little different, and each one of them is important, but each one of them is important at different stages of life. So we wanted to kind of break down those different concepts and make sure that you're focusing on the right ones at the right point in time. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on the News Radio WFLA Orlando network, along with 96.9 The Game. We also happen to be one of the World Wide Web's top 25 financial planning podcasts. So make sure you check us out on your various social media or podcast channel of choice. Just look for us under Dollars and Cents with Joel Garris or Nelson Financial Planning. You can get directed to our channels that way. If you can't find us or have a problem looking that up, just go to our website, nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of different icons. Click on one that looks most familiar to you, and you'll get directly connected to our channel. So make sure you're subscribed to us on those platforms as well. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So if we think of those terms, right, financial planning, retirement planning, investment planning, and income planning, they all sort of sound somewhat alike, but there's definitely a distinction between the two. So we're going to try and talk about that today on the program, and also to sort of draw that distinction of which one becomes more important at different points in time. And so we'll start with sort of the broadest term out of all 4 of those, and that of course is this concept of financial planning. That's, for example, why our firm is called Nelson Financial Planning, because it's sort of the broadest term that you can use to describe some of the services that a financial firm will provide. Previously, in a different era, we were known as Nelson Investment Planning Services, and the reality is that particularly when we added in our tax service and our tax preparation service, it dawned on us that, well, that's a much broader cross-section of the services that we're providing. So let's choose that broader term, and the financial planning being the broadest term, to really help explain to folks just how broad that range of things is that we do. So financial planning, much like the name of our firm, is sort of the broadest term. That sort of includes everything, right? So you would look at how old you are, you would look at your goals, you would look at what you owe, you would look at what you own, and then look at how much money's coming in and how much money is coming out, what the family situation is, sort of that whole picture of equating your personal life to a net worth statement or a profit and loss statement, and then looking at that information to develop a plan to improve your overall finances. From that, it becomes sort of a bit of a strategy, if you will, of maybe getting rid of debt. That helps to improve your net worth. If you have less debt, then your net worth goes up. saving money for the future, maybe saving for college, things like that, maximizing out different ways in which you can save money or help to reduce your expenses. So that's sort of the overall concept, if you will, the overall umbrella of financial planning. Next up would be sort of retirement planning, and that's where you really start to look at what are the options available for me to save money for retirement. And typically you have to look first at, okay, well, what's my employer offering? Are they offering a 401k, a 403b, a 457? Maybe they're even offering a pension plan, so that would be kind of neat in today's world. And then if they're not offering a plan, what can I do on my own to help save for retirement? So when you talk about retirement planning, that really does sort of focus on that purely the retirement goal, where you're looking at saving now and trying to project out what the future might be, and then looking at what your expenses might be in retirement. This is also where, under the sort of the retirement planning umbrella, this is also where you would come into the notion of trying to figure out how to maximize out your Social Security, things like that, your pension. Where does that all come into play in terms of providing you income in retirement? So that's kind of the retirement planning side of things. And then the next sort of piece of the puzzle would be the investment planning side, right? So the investment planning side, as the name suggests, focuses predominantly on the investment side. This is a deep dive into the assets that you own and a full analysis of the mix: how much in stocks, how much in bonds, what sectors, what countries, the names of those companies that you own in your portfolio, what your top holdings would be, your performance of that portfolio, and in particular the performance of that portfolio versus the applicable benchmark. So all of that, a very deep dive into what things look like on the investment side based upon what you currently own. That's the notion of investment planning. One of the best things, or the best tools that you can use, is the folks at Morningstar have something called an X-ray. That X-ray is basically a software that takes all of your holdings and sort of amalgamates it into one big giant snapshot, so that you can see, even though you may have like 10 different funds, if Microsoft is in each of them, you probably want to know, well, wait a minute, how diversified am I really being right now if Microsoft is sort of a common holding throughout all of the different funds? So what that means is, if you use a report like a X-ray type report, then you're able to really see exactly what your investment mix is. Key piece on that is, be sure to also add in to that investment analysis whatever it is that is in like your 401k or your 403b or your 457 or your simple, whatever the plan is at your employer. Make sure that you incorporate that into that analysis as well, so you really can get an overall broad-based view of the investment planning side of things. And then lastly, you can kind of see how each one of these becomes important at different points in time, right? Financial planning is one that certainly is much more important. What's important all along, but it's probably more important to kind of as you're getting started, right? You want to get on the right financial path. You want to get the right financial plan. The investment planning, probably one of those ones that is certainly important, particularly as you start to have a good chunk on the invested side of things. You've moved past paying off your credit card debt. You move past saving money and putting it aside for an emergency savings. And ultimately now you're on the investment side. Retirement planning, obviously that's important. More important if you're like 10 years away versus 30 years away. And then the last one is this notion of income planning, and that's the one that's most important, particularly when you get close to retirement. And that looks at exactly where your income is going to come from. And that requires a much more in-depth tax analysis than any of these others really do, because the notion of being tax efficiency in retirement can add a tremendous amount to the amount of money that you get to keep and spend on a regular basis each and every month in retirement. So that's where, with the income planning, that tax analysis really comes into play to help determine where exactly you've got to take money from which accounts and when, and takes into account all of those required rules, right? Because retirement accounts have a bunch of required rules. Today, you require minimum distribution out of your retirement accounts, not 70.5 anymore, it's 72. So you got a little bit more flexibility on that. But if you inherit a retirement account, you no longer have the flexibility of spreading that out over the course of the rest of your life. You must take that out over a 10-year period of time. So that means it doesn't matter when you get that, you've got to sort of look at that 10-year window and say, okay, what's the best way to do that? So, of course, all of these concepts are important, right? Financial planning, retirement planning, investment planning, income planning. But you can see how where at different points in time, each one of those may be more important to you. So you want to make sure that you're using that holistic approach to really be able to seamlessly move from these different types of concepts in order to make sure that you're getting the best possible financial results over the course of your entire lifetime. So some important concepts that we wanted to spend a little bit of time on the program today talking about and emphasizing that, yes, they all sound like they're the same, but the reality is each one of them has some unique characteristics that become more important at different periods of time in your life. With that, we'll take a break here on Dollars and Cents on News Radio WFLA Orlando. International investing. What is it and why is it important? You may want to double check where your allocation is, particularly on the non-US side of things, because a lot of things have happened over the course of the past few years, and we think there's 3 solid reasons to be thinking more about internationally today, particularly in light of some of the things that are happening here in the US market. So we're going to share some of those things to be thinking about as it relates to your asset allocation on the international side on this segment on the program. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you simultaneously on the 96.9, the Game Network, along with News Radio WFLA Orlando. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So what exactly is international investing anyway in the first place? Well, it's owning companies that are headquartered outside the U.S. That's the very core of it today. And when you think about companies outside the U.S., we don't realize that a lot of what we use or a lot of what we consume is in fact made by companies that are headquartered outside the US. So if you enjoy Nestle products, that's a company that is headquartered outside the US. If you enjoy a Budweiser every now and then, talking about last night, having some beers with some friends, the reality is, although we weren't drinking Budweiser, were we? Oh well. Anyway, the Budweiser would be a company that is now headquartered outside the U.S. So a lot of those products that we consume on a regular and daily basis, the reality is that they are in fact headquartered, or their corporate parent or umbrella that they sit under is in fact located outside the U.S. And the problem today is that many folks just sort of track the indexes, and perhaps the biggest one that is tracked, of course, is the S&P 500. Well, and so many different funds and so many different investments sort of gear to track that. But the problem with that is that the S&P 500 is in fact the 500 largest U.S. companies. So that is solely very U.S. centric. And so we're seeing a low overweight to non-U.S. companies, yet non-U.S. companies headquartered outside the U.S., in fact, make up over half of the market capitalization that exists on the planet today. So if you were to have a portfolio that in fact reflected global market capitalization, the majority of your portfolio would actually be outside the U.S. for many investors, the amount that is outside the US is in the teens or lower in terms of the percentages. We think that really does require some evaluation, particularly in light of sort of three concepts that we're going to share today. And it's certainly been easy to sort of steer away from the international side of things, particularly of late, because past 10, 12, 13 years, there's been the largest period of relative outperformance for the US markets to the international market. So it's easy to sort of wind up chasing, the stuff that's doing better. And if you don't actually do any kind of a rebalance over time inside your portfolio and just kind of let things run, well then, yeah, your US exposure would be much greater than it was a decade ago. Your international would be less, simply because of that spread in terms of performance. But there's definitely some things to be considering, particularly when you look at sort of the relative US versus non-US markets. And I think that the chief among them is this notion of concentration of the top five, the big dogs, if you will. And we've talked about this on the program before and referred to the S&P 500 as the S&P 5, given how big of an outperformance or how big of an over-contribution that the five largest holdings have in that index. To recap, if you look at those big five names, Apple, Microsoft, Amazon, Google, and Facebook, those five companies have contributed nearly 1/3 of the cumulative return for the S&P 500 over the course of the past 5 years. Let me say that again. Top five companies, 500 company index, top five companies, the FANGs, have contributed nearly 1/3 of the cumulative performance over the past 5 years for that index. That, folks, is the very definition of concentration. If you flip that and you look at that same top five, like the five largest holdings in the international index, then you'll see that the five largest holdings, which, by the way, would be Nestle, Roche, Novartis, both those are drug companies. ASML, that's a big tech company. They supply like the supplies to chip makers and things like that. And then Louis Vuitton, Hennessy, which is a big sort of umbrella company that has all of those luxury good brands that make up part of its name, right? Louis Vuitton, Moet, Hennessy, all of that. And they, so you got fancy bags, you got liquor, you got champagne, you got the whole thing in there. So, but those five companies, five largest companies of the international index, have contributed about 6% of the total cumulative return for the international index over the course of the past 5 years. And obviously, you're the five largest companies of an index, you're still going to be a major factor in the performance. But when the top five here in the US have contributed 30% and the top five outside the US have contributed 6%, you tell me which one's more concentrated. I would be more concerned about what's been going on in the US, particularly when you have that level of concentration. So certainly something to kind of consider that, along with the other issue is that US companies have disproportionately engaged in share buyback. You haven't seen that happen in other places around the world. And let's just recap what share buyback does. If I'm a company and I buy back shares, right, that means I have less shares outstanding, which means then that if I have X number of earnings and I'm dividing it by a smaller amount, that means my earnings per share is in fact better than what it would otherwise have been had all of those shares still been outstanding. So another trick that US companies in particular have done is, by doing all these share buybacks, they've been able to kind of continue to keep their earnings per share growing steadily because there's simply less shares out there. So that alone is also another distinction. Hasn't really happened much on the international side. So the earnings on the international are, relative to the number of shares, a little bit more robust because you haven't been spending money to buy back the shares. And then the other thing, of course, is valuation. Let's not forget valuation. When you look at simple ratios like the price earnings ratio, which is a traditional measure of measuring value of a particular company, you look at its price, the stock price that it has, versus the earnings. And obviously You want that PE ratio to be as low as possible, right? Because you don't want to have to overpay for earnings. So the PE ratio is a very traditional metric for measuring relative valuation. Today, if you look at the S&P 500, you'll see that it's at about 33, 34x, meaning in terms of that PE ratio, and historically typically around 27. Meanwhile, if you flip over to the non-US side of things, you'll actually see where PE ratios there are about 15x versus traditionally being about 17x. So in fact, there it really does, when you look just simply at the valuation metrics, that it really does seem to be a much more of an opportunity on the non-US side of things than the US. So bottom line, we encourage folks to rethink their international mix. Number one, you got to figure out where it is today. Check it out, make sure exactly what that number is as a percentage of your portfolio, and then sort of consider the opportunities, right? You've got some interesting things about concentration and buybacks and valuation that we've shared with you here on the program to be thinking about as it relates to your portfolio. With that, we'll take a break and continue on after these messages here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. So what are some of the common misconceptions about Social Security and marriage? You often have folks understand that, well, as a spouse, I can apply under my spouse's record, but what are some of the limitations or myths behind that? And so the devil, as is always the case, is in the details. And so we wanted to kind of spend this segment of the program sort of talking about some of those myths and ultimately how they might affect you, particularly if you're planning on applying for Social Security. So welcome back to the program Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning. Give us a call this week. See if our team of certified financial fiduciaries can help you change your life. So there's a lot of unique things about Social Security, and one of which is that if you are married, right, then you've got some options that you can kind of pick and choose between. And so Social Security, in a way, sort of sweetens the deal if you are married, and well, it can also sweeten the deal if you are divorced as well, which we'll share with you in just a second, because the reality is that you have the option to claim on your work record, or you can claim up to 50% on your spouse's or ex-spouse, assuming a couple of different things. Number one, you were married for at least 10 years, and number two, you haven't remarried. The reality is that if you've got a limited work history, maybe you were at home raising kids, or maybe you had other things that you were dealing with, caring for parents, whatever the case may be, you've got, typically in a couple, you've got one that does not have the majority of the work record as another might, and that's certainly true in many couples. And so what Social Security does is it allows that person that doesn't have as strong of a work record to look at claiming up to 50% based upon what their partner receives. So one of those things is one of those common misconceptions is that this ability to apply on your spouse's record, first of all, it doesn't affect how much they're getting. I think people think, oh, well, I'm going to reduce that, I don't want to do that. And that's not the case at all. The reality is you can collect on your spouse, and as we said earlier, you can collect on your ex-spouse, assuming that you were married for 10 years and you have not remarried. If that applies, if your spouse qualifies or eligible to collect, but not collecting, the ex-spouse can in fact still apply. So it doesn't affect their benefit, and so it's still an option for people to be able to apply to someone else's record, and it doesn't reduce down how much they are getting. If you are claiming on your spouse, then you can't really continue to earn retirement credits, though, on your own money. In other words, a lot of people will wait past their full retirement age to gain an extra 8% per year. If you wait the full 12 months, you wait less, then it's calculated each month that you wait. The reality is over 12 months, you can earn up to 8% more in your in your Social Security benefit if you're waiting past your full retirement age. If you apply on your spouse's record, then that piece won't continue on your own record. So it's not like you can, let yours continue to grow while in fact you are collecting as a spousal benefit. Here's the other thing too, is you don't necessarily get 50% of the benefit. That's really the maximum that you can get. If you're collecting it early, it may be as little as 32.5% of the benefit. The only way you get to that 50% maximum number for a spousal benefit is if you are at your full retirement age. Otherwise, it can be reduced. If you're collecting it at age 62, again, that can be reduced all the way down to 32.5%. So there can certainly be some shifts in terms of how much you're able to actually get from under that spousal benefit. Another thing to consider, and this one is a common misconception because it changed but not all that long ago. This actually changed in the year 2015, so that's only like 6 years ago. And so many people are still sort of operating under the old premise of this, and that's the notion of taking spousal benefits and then switching to your own record later on and collecting a higher benefit. In essence, okay, great. How it used to be prior to 2015 is you could apply for spousal benefits, not apply based upon your work record, and then because you weren't applying under your record, then that was continuing to increase. It would continue to increase by 8% per year past your full retirement age, all of that, and then you would flip over at age 70 to your work record and then thereby achieve a higher benefit. That was completely eliminated. That is only an option if you were born before January the 2nd of 1954. The reality is that back then was known as a restricted application. The lower earning spouse could claim and then switch over to their record at a later point. That has been completely eliminated. That's no longer an option. And then beware of what happens at the death of one. You don't get to keep both. It actually goes to the higher amount. You sort of always lose the lower amount of the two Social Security checks that were coming on in. And if you're under full retirement age, you may not in fact get all of that amount. So for example, if you apply for a widow's benefit, which you can as early as age 60, obviously that's before your full retirement age, you may only get 70% of what the benefit would be. So just be aware that when one passes, then you're going to see a change in the amount of Social Security that's coming in. So beware of those various different things that come into play when it comes to Social Security and some of the common misconceptions that are out there. With that, we will wrap it on up and get on out of here. Have a wonderful Sunday morning. You've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando.